Stop what you're doing right now and tune in, because within the next couple of months, we're likely to enter a recession if we're not in one already. Now, this could be one of the greatest opportunities of your whole life to grow your wealth, so you're not going to want to miss out on it. Now, recessions are generally seen as being a bad thing. However, they're really just part of the natural business cycle. We've always recovered from them in the past. However, it is very, very important to invest your money during recessions, because you'll likely see a much higher growth rate in the future. Considering once we exit the recession and enter into a period of growth, you will see much higher returns than people who waited to invest once we return to a period of growth. Now, if you do enjoy the video, I would appreciate it if you gave it a thumbs up and left a comment in the comments section about what I can do better and for video ideas in the future. And if you do enjoy it, please do subscribe. It means the world to me. Without further ado, let's get into the video. This leads me to the first point, which is that cash is king. Now, many of you may have seen inflation data in the near double digits percent, which is pretty insane, honestly. And you may think that holding a lot of cash right now is not a great idea. However, like I stated previously, when we do enter a recession, we are likely to continue to see the stock market and real estate prices decline. Now, a way to mitigate this is that many banks, they do only give you about 0.1 to 0.4% interest on your money, which is not very much at all. However, some banks tend to give a higher interest rate, and the bank that I'm currently using to do this is called Marcus, and that gives me 4% APY. And now this is much bigger than my other banks, which I previously used to give me, which kind of helps to hedge that inflation just a little bit and take that edge off. Now, Marcus, they currently give you 3% APY. However, for the first 3 months, if you use somebody else's referral link, they will give you an extra 1%. And if somebody else uses your referral link, that person gets 1% and you get 1% for the next 3 months on top of that. So that's an extra percent that you wouldn't be making even before. And so I'm not sponsored by Marcus or anything like that, but I will leave the link in the description to sign up for a Marcus account so you can start earning a little bit more interest on your money. Now, before you start investing in stocks, you really want to save up a 6 to 12 month emergency fund. Now, what this is 6 to 12 months of expenses, especially in a recession, because you may get fired or laid off from your job, and not having that income could really hurt. And if you do start investing in stocks, you may have to withdraw that money at a lesser value than you put it in at, because you don't have any cash on hand. This is also important because if you have a large unexpected expense in a recession, or really at any time in your life, you're going to want to have this cash saved up so you can pay for that without going into something like credit card debt. Now, you also want to have your credit card debt, student loans, and other high interest debt paid off before you start investing, because these credit card companies can charge 15 to even low 20%, of 22% on their interest for their credit card, and you don't want to be stuck in something like that, because that is definitely a road to poverty. And now, paying off your credit card debt, it may not seem as appealing as investing. However, you can make that seem a little bit more appealing by telling yourself that you're getting an instant return on investment on that money by paying off that principal now instead of waiting long periods of time to accumulate that debt even more. This brings me to my second point, which is intelligent investing. Now, during a recession, timing the market itself can be very, very difficult. Now, this could result in you investing your money too early and you losing a large sum of money before the market actually recovers, or you investing too late and you missing the opportunity to invest at a lower point in the market. Now, an easy solution to this is called dollar cost averaging. Now, dollar cost averaging is, say, for example, you have $10,000 to put in the market. Instead of putting it in all at once, you would put it in at 5 equal payments of $2,000. Now, this would help to mitigate the risk of you putting it in all at once, because if you put it in all at once, it could go down, it could go up. Nobody really knows. Now, putting it in at 5 different times, you may time the market a little bit better, a little bit worse, but at least you'll mitigate the risk of putting it in all at once, so you're not risking that money all at once during such a versatile time. Now that you know this, you need to know what account to open to start investing during a recession or during any other time. Now, the first thing I would suggest for you to do is to look into your company's 401k options or look into opening a Roth IRA. Now, a Roth IRA, depending on your age, you can contribute $6,000 to $7,000 a year. And upon the age of 59 and a half, you're able to withdraw all of this tax-free. And so I would really consider looking into these options. Now, with a 401k, it's a little bit more difficult because your employer may be matching some and you're really able to adjust your risk tolerance. So that's something that you would need to take up with your employer and the company that you're working at. Now, I would really consider opening these up first before you consider opening an individual account, considering those are all taxed for capital gains. And so whatever gains you make on that, you will have to pay taxes on those. And so now you need to know what to invest in. Now, there's so many things out there, from real estate to cryptocurrency to stocks. And my number one choice are ETFs. Now, an ETF, or an exchange-traded fund, instead of one asset or one company, it is a group of assets or a group of companies, and this helps to lower your risk, considering if one of these businesses or one of these assets takes a massive drop or even goes out of business completely, then there will likely be another one in that group that will recover for those losses, especially during times of growth. And now, my top picks for these ETFs are VTI, which is Vanguard's Total Market Index, which is a very broad spread of these high risk, low risk, all of these types of stocks. And another one of my favorites is VOO, and this is Vanguard's S&P 500, which is also very diverse. And if one of these companies goes out of business, which is not really as likely considering they're all S&P 500 stocks, then there will be another one that will pick up for that. And so whatever investment you choose to invest in, you need to be educated in that. And that means doing your own independent research on what you're actually investing in. Now, last year we saw this big fear of missing out, which is a very popular term, of Bitcoin. And since this fear of missing out, we have seen this massive decrease in stock prices, but even bigger in things like Bitcoin and Ethereum. And since last year, Bitcoin has gone from $50,000 per coin to $17,000 per coin. And that's around a 70% decrease, whereas the S&P 500 is down around 20% right now. And I'm not saying that crypto is bad. Cryptocurrency, just like any other investment, can be very profitable in the long or the short term, but you really need to know what you're talking about before you put your money there. And now, it's really important to have a trading plan for whatever you're trading, whether that be stocks, cryptocurrency. I mean, even big things such as real estate, you need to go in there educated and having a plan on what you're going to do when you're getting in, when you're getting out, whether it's a short or a long-term investment, and having those things will help you to make money in the long term or the short term. So my last point for this video is to simply just be patient. Now, with a recession, like I said, it can be a very volatile time, meaning that stocks can go up and down a lot before they start to stabilize and take an actual position upwards or downwards. And now the key to this is not to panic sell. Now, you might look at your account and think, oh my gosh, I'm down 5% this week, or I'm up 2% this week. And so panic selling can lead to you selling an asset at a loss way too early, and then it goes up in the future and you're like, oh my gosh, I missed out on that opportunity. And so this is one of the reasons why you really need to have an emergency fund and to pay off high interest debt early, is because if you do incur a large expense during this period of time, you may be forced to sell a position too early. So a way that I personally approach this risk is just by simply not checking my account on a daily basis. Now, I used to be checking my stock account every single day, and it would be up 2% a day, down 2% a day. I mean, especially a lot of you guys know that this year has not been the greatest year for the stock market, and it has been all over the place all year long. And so just not checking my account every single day and checking it once a month or something like that has really cleared my mind a lot more and has helped me to focus on other areas of my life while it's such a volatile time. So I hope you guys enjoyed some of these tips on how to grow your wealth. And to go over everything, the points that I've made in this video are that cash is king, intelligent investing, and to be patient. Now, if you've made it to this point in the video, I really, really appreciate you staying and watching the whole thing. I have committed to posting 2 new videos at least every week for the next year, so hopefully you'll see a lot of me in the future. Now, you guys have a wonderful day.